Welcome to Safe Simple Sound Podcast. I am your host, PK. Today we have an exciting episode lined up where we use AI voices to bring insightful discussions to life. But before we dive in, please note this podcast is for entertainment and educational purposes only and does not constitute financial, legal, or professional advice. Investment decisions should always consider your personal circumstances, financial goals, and risk tolerance. Be sure to consult a qualified financial professional before making any investment decisions. If you would like personalized guidance, you can reach out to me at savesimplesound.com/contact. Now, let's get started.
Hey everyone, this is Alex. Welcome back to Safe Simple Sound. Today we're diving deep into the psychology of investing, exploring how our minds can be both our greatest asset and our biggest obstacle on the path to financial freedom. Today's episode is based on the article titled The Psychology of Investing, Bringing It All Together on safesimplesound.com website, which provides a comprehensive overview of how our mental and emotional states impact our financial decisions. This aligns perfectly with our secured principles here at Safe Simple Sound, especially the understand financial choices aspect, because truly understanding why we make certain financial choices is crucial. This article highlights several key concepts, including the disposition effect, that pesky tendency to hold on to losers and sell winners too early, and the impact of cognitive biases like confirmation bias and anchoring on our portfolio construction. We'll also explore how technology, while offering incredible tools, can amplify some of these psychological challenges through information overload and the fear of missing out. So, to guide our discussion today, we'll be following the structure of the article, breaking it down into three key sections. First, we'll tackle the disposition effect and its influence on investment decisions. We'll hear from listeners facing real-life scenarios like holding on to a losing stock despite mounting evidence against it, and prematurely selling a winning investment only to watch it skyrocket. Then, we'll move into the realm of cognitive biases and portfolio construction. We'll explore how biases like confirmation bias can lead an investor to overinvest in a specific sector, like tech stocks, simply because it aligns with their pre-existing beliefs, and how anchoring can impact real estate decisions. Finally, we'll wrap up by examining the double-edged sword of technology in investing. We'll delve into scenarios of information overload, leading to decision paralysis for new investors, and how the constant buzz of social media can fuel FOMO and push us toward impulsive investments that don't align with our long-term goals. Get ready for an insightful episode packed with practical tips and actionable strategies. We'll be uncovering how to recognize these psychological pitfalls, manage our emotional responses, and ultimately make sounder financial decisions. It's all about empowering you to seize financial control and create a secure financial future right here on Safe Simple Sound. So, let's dive in. We received an email from a listener who's in a bit of a predicament. They bought a stock at $100 a share, and now it's trading at $50. They're hesitant to sell, convinced it will rebound eventually. They're emotionally attached to the company, and the idea of realizing that 50% loss is really tough. This touches on what our reference article calls the disposition effect, the tendency to hold losing stocks too long and sell winners too early. Sam, what are your thoughts on this? At what point does hope become denial in investing?
Hope without a solid basis becomes denial. It's crucial to distinguish between optimism based on sound analysis and wishful thinking. A price drop doesn't automatically signal a bad investment, but clinging to a loser without reassessing the underlying fundamentals is dangerous.
That makes sense. So how can investors differentiate between a temporary dip and a fundamental problem with a company? This reminds me of when we talked about market cycles in episode 38. Downturns are inevitable, but some companies don't bounce back.
Exactly, Taylor. A temporary dip might be due to broader market fluctuations, short-term negative news, or even just normal price volatility. A fundamental problem, however, impacts the long-term viability of the business. Think of it like this. A dip is a pothole in the road. A fundamental problem is a washed-out bridge. You can drive around a pothole, but a washed-out bridge requires major reconstruction.
That's a great analogy, Sam. So, looking at the company's financials, their competitive landscape, and their overall strategy is essential, especially when a stock experiences a significant drop.
So, if I understand correctly, if the company's core business model is still strong and the price drop seems unrelated to its long-term prospects, it might be a temporary dip. But if the drop is due to, say, changing consumer behavior that directly impacts their revenue streams, then it's potentially a fundamental problem.
Precisely. Let's say a company relies on a specific technology that's quickly becoming obsolete. That's a fundamental issue. Conversely, a short-term supply chain disruption while potentially impacting earnings might not be a deal breaker if the long-term demand for their product remains robust.
This connects back to our discussion about having a clear investment thesis. You should have a rationale for buying a stock in the first place. If that rationale is no longer valid due to fundamental changes, holding on to the stock becomes more about avoiding the pain of a loss than about sound investing. So, to recap, clinging to losing stocks based on hope alone can be detrimental to your portfolio. Differentiating between a temporary dip and a fundamental problem requires carefully examining the company's prospects. Taylor, any final thoughts?
I think the analogy of the pothole versus the washed-out bridge is incredibly helpful. It's a reminder that you have to assess the situation, not just hope for the best.
Great point. Our call to action for this segment is to review your investment thesis for any stocks that are significantly down. Ask yourself, are the reasons you bought the stock still valid? And consider setting stop-loss orders to limit potential losses in the future. This can help take the emotion out of selling decisions. So, Taylor, in our last segment, we discussed holding on to losing stocks, sometimes way past their prime, hoping for a rebound that might never come. It's a tough situation, and many listeners wrote in sharing similar experiences. But today, we're flipping the script and talking about the opposite problem: selling winners too early. We received an email from a listener who's experiencing some serious regret. They bought a stock at $50, watched it climb to $100, and feeling pretty good about themselves, sold it immediately to lock in that profit. Seems like a smart move, right? Well, the story doesn't end there. The stock then doubled again to $200, leaving our listener feeling like they missed out big time. This is a classic example of what behavioral finance calls the disposition effect, covered in our reference article, The Psychology of Investing, specifically in Part 1. Sam, can you unpack this for us a bit?
Sure, Alex. The disposition effect is this tendency we have to sell winning investments too early and hold losing ones too long. It's rooted in the way our brains process gains and losses. Selling that stock at $100 felt good, a concrete win. Holding on while it went to $200 involved the risk of it dropping back down, and our brains are wired to avoid that potential pain, even if it means sacrificing potential gains.
So it's like cutting your losses short and letting your profits run. Juan. In reverse, I think I've definitely done this before. It's that instant gratification feeling, isn't it? You see the profit and you want to grab it.
Exactly. It plays right into our emotions. And that brings us to our first question for today. How can investors identify long-term growth potential and avoid being swayed by these short-term market fluctuations, Sam?
One key is understanding the underlying business. Is the company's growth sustainable? Are they innovative? Do they have a competitive advantage? This requires research beyond just looking at the stock price. Think of it like buying a house. You wouldn't just buy based on the curb appeal. You'd look at the foundation, the plumbing, the neighborhood. Similarly, evaluating a company's fundamentals provides a more objective view than just its current price.
So if I understand correctly, instead of reacting to the price going up, you should be looking at whether the reason the price is going up is sound. Like, if it's driven by real value creation as opposed to just market hype, then it might have more room to grow. This reminds me of what we discussed about fundamental analysis in episode 31, connected to the reference article's Part 3 on portfolio psychology.
Precisely. And that leads us to our second question. What strategies can help overcome the fear of missing out FOMO and allow for more disciplined investment decisions?
Having a clear investment strategy is crucial. Define your goals, your risk tolerance, and your time horizon. This acts like a roadmap, helping you make rational decisions even when the market gets turbulent or when you see others making seemingly quick profits. The reference article mentions this in Part 6, emphasizing emotional discipline.
A roadmap. I like that analogy. So, if my goal is long-term growth, even if I see a stock double quickly, I should stick to my plan if the fundamentals still look good. It's about delaying gratification for potentially bigger gains later on, right?
Exactly. And remember, FOMO is amplified by social media and constant market access, as discussed in Part 4 of the article. So, setting boundaries with those can be helpful too. So, key takeaways: avoid getting swept up in the euphoria of short term gains. Analyze the fundamentals and stick to your long term strategy. Don't let FOMO dictate your decisions. For our listeners, the call to action is to research different valuation methods and develop a long term investment strategy aligned with your goals. In our next segment, we'll explore another common psychological pitfall: confirmation bias, and how it can lead you down a rabbit hole of bad investment choices. Imagine an investor who's convinced that technology is the future. This isn't inherently a bad belief. Of course, technology is transforming so many aspects of our lives. But this investor primarily consumes news and analysis that supports this belief, while dismissing anything negative about the tech sector. They're essentially building an echo chamber around their investment thesis. This, friends, is a classic example of confirmation bias in action. Sam, as our expert today, can you shed some light on how investors can first identify and then mitigate this confirmation bias in their own research and decision-making process?
Absolutely, Alex. Identifying confirmation bias starts with self-awareness. Ask yourself, am I actively seeking out information that challenges my investment thesis? Or am I just reading headlines that reinforce what I already believe? A good starting point is to diversify your information sources. Don't just stick to one website or financial guru. Explore different viewpoints, even those that contradict your own. Then actively engage with those differing perspectives. Don't just dismiss them. Try to understand the reasoning behind them.
So, if I understand correctly, even if I believe in a particular sector like tech, I should actively search for articles and reports that highlight potential downsides or risks. That feels almost counterintuitive. Wouldn't it create more confusion?
It might initially, Taylor, but think of it as stress testing your investment thesis. You're essentially trying to poke holes in your own logic, preemptively addressing potential weaknesses. This reminds me of the reference article we've been discussing, where they mention biases affecting portfolio decisions. Confirmation bias specifically leads us to seek out information confirming existing beliefs rather than objectively evaluating all available data.
Exactly, Sam. This concept of stress testing is powerful. It's like building a bridge. You wouldn't just test it for the expected weight. You'd also test its resilience against extreme weather, heavy loads, even earthquakes. Similarly, you want your investment strategy to hold up even under challenging market conditions.
This connects to what we discussed earlier about diversification, right? If I'm only invested in tech and the sector experiences a downturn, my entire portfolio is vulnerable. But if I'm spread across different sectors, the impact is mitigated.
Precisely. Diversification acts as a buffer against confirmation bias, forcing you to consider other sectors and investment opportunities you might have otherwise ignored.
Let's use a simple example. Suppose you're convinced company X is the next big thing in AI. You're constantly reading articles about their groundbreaking technology and future prospects. But what if you also dedicate some time to understanding the competitive landscape, potential regulatory hurdles, or even ethical concerns surrounding AI? This broader perspective helps you make a more informed decision.
Now, to the second part of my initial question, Sam, what are the real dangers of relying solely on information that confirms our existing beliefs?
The danger is you become blind to potential risks and overestimate potential rewards. This can lead to concentrated portfolios and significant losses if your core belief turns out to be wrong. Imagine our tech-focused investor during the dot-com bubble. They may have ignored all the warning signs because they were so convinced that tech is the future. This mindset can be incredibly dangerous.
So to summarize, overcoming confirmation bias is about actively seeking out diverse perspectives and stress testing our investment theses. We need to be aware of the danger of living in an echo chamber where we only hear what we want to hear.
Absolutely. And this applies to all investments, not just tech stocks. The key takeaway here is to be a critical thinker, challenge your assumptions, and always seek a balanced perspective. So, Taylor, we just talked about how confirmation bias can lead investors to double down on tech stocks even when the market signals caution. Another cognitive bias that can really trip us up, especially in large purchases like real estate, is anchoring. Imagine you're looking to buy your first house. You find a place you love, and the asking price is $500,000. That number sticks in your mind, becomes your anchor. Even if comparable properties in the area are selling for significantly less, or if the house needs repairs that justify a lower offer, that initial $500,000 can make it hard to negotiate objectively. This scenario is precisely what one of our listeners wrote in about. They're struggling to shake the initial asking price, even though they know deep down it's likely inflated. Sam, can you help us understand what's happening here? How does this anchoring bias, this getting stuck on a specific number, influence our perception of value, not just in real estate, but in other investments too?
Anchoring bias is a powerful cognitive shortcut our brains use to simplify decision-making. We latch onto an initial piece of information, the anchor, and use it as a reference point for all subsequent judgments. In real estate, it's the asking price. In stocks, it might be the price you first bought the stock at or a previous high. This affects our perception of value because we tend to judge everything relative to that anchor, even if the anchor is arbitrary or irrelevant.
So, if I understand correctly, even if I know a stock's intrinsic value is higher than its current price, if I initially bought it at a much lower price, I might be hesitant to buy more because I'm anchored to that initial price.
Exactly. You might think it's too expensive now, even if logically it's undervalued.
So, how do we break free from this anchor? What techniques can investors use to make more rational decisions?
Awareness is the first step. Recognizing that anchoring bias exists and can influence your thinking is crucial. Then, try to actively seek out different perspectives. In real estate, get independent appraisals. With stocks, research different valuation models and compare the current price to the intrinsic value.
This reminds me of what we discussed about confirmation bias. We need to actively look for information that challenges our initial assumptions, right?
Absolutely. Diversifying your information sources is key. Don't just rely on what the seller or the company is telling you. Look at comparable properties, competitor performance, industry trends.
Another effective technique is to deliberately consider the opposite. If you think a house is worth $450,000 based on the asking price of $500,000, force yourself to consider why it might be worth only $400,000 or even less. What factors could justify a lower price? This helps you break free from the anchor and consider a wider range of possibilities.
So to recap, anchoring bias can significantly influence our investment decisions, making us overvalue or undervalue assets based on an initial piece of information. To combat this, we need to be aware of the bias, seek out diverse perspectives, and actively consider opposing viewpoints. If you're considering a major purchase like real estate, remember the importance of thorough due diligence. Get independent appraisals, compare prices with similar properties, and don't be afraid to walk away if the numbers don't add up. So Taylor, we just discussed how anchoring bias can affect real estate decisions. But it's not just about houses, right? This fixation on a particular price point or even a piece of information can crop up anywhere, especially when you're bombarded with data. Which leads us perfectly into our next discussion about information overload and decision paralysis in the world of investing. Imagine this. Taylor, you've decided to start investing. You're excited about building your financial future. You hop online, ready to learn and explore, and bam, you're hit by a tsunami of information. Blogs, forums, social media, financial news sites, and countless investment apps all vying for your attention. Suddenly, that initial excitement turns into a knot of anxiety. There's so much to learn, so many options. Where do you even begin? You feel frozen, unable to make any decisions for fear of making the wrong one. This, my friends, is the very real struggle of information overload, leading to decision paralysis. Sam, as our expert, have you seen this play out with new investors? How can new investors navigate this overwhelming amount of information available and avoid decision paralysis? And perhaps, even more importantly, what are some reliable sources of information for beginners who are just starting to dip their toes into the market?
This is extremely common, Alex. It's like walking into a giant supermarket with thousands of products and trying to pick out ingredients for a recipe you've never made before. One key is to start with a basic shopping list, the foundational knowledge. Reputable sources like the SEC website, investor.gov, and established financial institutions offer educational materials that break down complex concepts into digestible pieces. Avoid getting caught up in the hot tips and sensationalized market commentary you often find on social media or less credible forums.
That makes a lot of sense. So if I understand correctly, it's about prioritizing quality educational resources over the constant stream of market noise, right? This reminds me of when we talked about confirmation bias earlier. If you're only looking for information that supports your pre-existing beliefs, you're likely missing a big part of the picture. And that can definitely lead to bad decisions.
Exactly, Taylor. And building on what Sam said, think about learning to cook. You wouldn't start with a complex souffle, would you? You'd probably start with something simpler, like boiling an egg. Similarly, in investing, start with the fundamentals, understanding asset classes, diversification, and risk management. Don't jump into options trading or complex derivatives before you grasp the basics.
Precisely. And just like following a trusted recipe, creating a simple investment plan helps you stay focused. Outline your goals, time frame, and risk tolerance. This framework will guide your research and prevent you from getting sidetracked by every market fluctuation or hot new stock tip. It's also crucial to remember that investing is a long-term game. Don't expect to get rich quick.
So having a clear plan acts as a filter for all the information out there. It helps you prioritize what's relevant to your situation and goals. This is really helpful. What about working with a financial advisor? Is that something you'd recommend, especially for beginners?
Absolutely. A qualified financial advisor can provide personalized guidance, help you create a tailored investment plan, and act as a sounding board. Think of them as your experienced sous chef, guiding you through the complexities of the market.
Great points, both of you. So, to recap, when faced with information overload, remember to prioritize quality over quantity. Start with the basics, create a plan, and consider seeking professional guidance. Don't let the fear of making a wrong move paralyze you. Start small, focus on reliable sources, and build your knowledge gradually. You don't have to become a financial expert overnight. In the last segment, we talked about information overload and how it can lead to decision paralysis, especially for new investors. Now, we're shifting gears to another way technology can mess with our investment psychology, the fear of missing out, better known as FOMO, and the powerful influence of social media. Imagine scrolling through your feed and seeing friends bragging about their incredible returns on some hot new crypto or meme stock. It's tempting, right? Suddenly, your carefully researched investment strategy feels boring, and you're itching to jump on the bandwagon. This is precisely the scenario we'll be unpacking today with Sam. Taylor, are you ready to dive into the FOMO frenzy?
Definitely. I think this is something a lot of us can relate to, especially with how pervasive social media is these days. I mean, I've definitely felt that pang of FOMO before, seeing others seemingly making a killing in the market while I'm sticking to my plan. It makes you question if you're doing things right.
Exactly. And that's the first question I want to explore today. How can investors resist that pressure from social media and avoid making impulsive decisions based on FOMO? Sam, what are your thoughts?
Well, the key is to remember that what you see on social media is often a highly curated, often unrealistic snapshot. People are more likely to share their wins than their losses. It's like seeing highlights of a basketball game. You only see the slam dunks, not the missed free throws. So taking everything at face value can create a distorted view of reality. A crucial first step is developing a personalized investment plan based on your own financial goals, risk tolerance, and time horizon. This will serve as your compass, guiding you through the choppy waters of market hype and social media pressure.
So, it's about creating a solid strategy and sticking to it, regardless of what's trending on social media. This reminds me of what we discussed about having clear entry and exit strategies back in episode 31. It's easy to get caught up in the moment, but having a predetermined plan helps you stay grounded.
Precisely. It's about having that discipline. Sam, what are some of the risks of actually relying on social media for investment advice?
The risks are substantial. First, the information you find on social media is often unvetted and can be misleading or outright false. Second, much of the advice is driven by emotion and short-term thinking, which, as we know, is rarely a recipe for long-term investment success. Third, it can lead to herd behavior, where everyone piles into the same asset, inflating its price artificially. When the bubble bursts, those who jumped in late are often left holding the bag. Remember what we discussed about market mechanics and emotional responses in episode 30? Social media can amplify those emotional swings to dangerous levels.
That makes a lot of sense. So a seemingly hot tip on social media could actually be a sign of an overinflated asset ready to pop.
Exactly. That's why due diligence and independent research are so important.
So to recap, we've talked about resisting the pressure of social media by developing a personalized investment plan and understanding the risks of relying on social media for investment advice. It's about having a plan and sticking to it. Don't let the fear of missing out drive your investment decisions. The call to action for our listeners today is to develop that personalized investment plan and avoid comparing your performance to others. And that's a wrap on our deep dive into the psychology of investing. We covered a lot of ground today, exploring how our minds can influence our financial choices, often in ways we don't even realize. Just like the article highlighted, technical knowledge is only half the battle. Understanding our own biases and emotional responses is crucial for long-term success. We touched on the disposition effect, those tricky cognitive biases like confirmation bias and anchoring, and how technology can be both a blessing and a curse for investors. I think those scenarios about holding on to losing stocks and experiencing FOMO from social media really hit home for many of us. Remember, it's perfectly normal to experience these emotions, but recognizing them and having a plan in place is key. As we discussed, creating a personal investment policy statement and having a market downturn response plan are crucial steps to navigate these psychological challenges. Thank you so much for tuning in to Safe Simple Sound. We truly appreciate you being a part of this community. Don't forget to check out the show notes for links to the article and other helpful resources. While you're there, leave us a review and tell us what resonated with you most from today's discussion. And of course, subscribe to the podcast so you don't miss our next episode. Remember, just like we emphasized at the beginning, understanding why we make certain financial choices is paramount. Keep learning, keep growing, and keep striving for that secure financial future. This is Alex signing off. Stay safe, stay simple, stay sound.
That's all for this episode. If you found it valuable, don't forget to subscribe to the podcast. For more insights, you can join my newsletter at safesimplesound.com. If you would like personalized guidance, you can reach out to us at safesimplesound.com/contact. Until next time, take care and bye for now.